This is one of the most important things you can do to become a better investor, and yet no one talks about it. I think no one teaches this technique because it's something only true professional investors do. Or maybe it's just because it requires you to humble yourself, and people don't really want to do that, especially publicly. But I'm about to do it for you because I think that showing you a real life example is the best way to teach you. And if you do this consistently, you will become a much better investor over time. The habit is simple, and I've broken it down into a 3-step process. Step 1 is to get a little notebook or start a Word doc or whatever you want to use. And step 2 is to write down every investment decision you make or don't make and why. For example, if I hear a headline or a stat and think, that might make XYZ an interesting investment, I'll write it down. And whether I decide to invest or not, I write down why I made that decision and what I was thinking at the time. Step 3 is every quarter or every year, or just simply when another similar decision comes up, you go back and review what you did or didn't do and why, and how that ended up working out. The process is way better than simply relying on your memory alone because 5 years later, you can look back at exactly what you were thinking in the moment and say, oh yeah, I forgot everyone was so worried about blah, 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 and that's why I didn't buy. And I should have. Well, this time I'm going to tune out the noise or whatever. It's a way better way to learn from your successes and mistakes to get better over time. And it will give you a huge informational and emotional advantage over the vast majority of investors who aren't doing this and are relying on their memories and their flawed human instincts. Luckily for you, I documented a ton of investment perspectives and calls on specific ETFs on this YouTube channel. So we're going to go back through the ETF calls and investment perspectives I shared in 2025, see how they worked out, and see what we can learn from them. It's a process every good investor should do, and I'm going to take you through a real-life example of it right now to incorporate a year's worth of valuable investment lessons into one video. Let's start with the biggest market-driving event of the year. In March 2025, Trump started hinting at the idea of reciprocal tariffs coming on April 2nd. So we did a video on it to share our perspective. Here's a snippet of what we said. But the reason that US stocks are down has everything to do with tariffs. That could get significantly worse on April 2nd and send stocks down much further. So what can you do to protect your portfolio from the worst case scenario? Well, you could sell everything, but that might be messy for tax purposes if you've got long-term holdings with a lot of gains in them. What might be better is to take a position in an ETF like VIXY or the very similar but even riskier 1.5x leveraged UVXY or the even riskier 2x leveraged UVIX. And how did VIXY, UVXY, and UVIX do after April 2nd? They rocketed upward between 69% and 162% over the next couple of days. Yes, they gave it all back, but that's exactly what I said would happen. Here's the rest of that clip. Or the even riskier 2x leveraged UVIX. None of these are for the faint of heart, and none should ever be held for more than a couple days, in my opinion. But if one were ever going to do it, now might be the time. So not only did I suggest that these might be good buys on or just before April 2nd, but I also made it clear that I wouldn't be willing to hold them for very long. But here's the best part. This is where past lessons have made me a better investor and what I hope to help you accomplish with this video and more broadly, this overall channel. I actually didn't think that the worst case was going to happen. I'd be surprised if he didn't implement anything on April 2nd, but I don't think it will be quite as bad as the worst fears would suggest. And I was wrong. It turned out to be worse than anyone expected. But I also said that it was the asymmetric return potential that made these ETFs attractive anyway. If there's a really good outcome on April 2nd and the market rallies, could this be down 10 or 20%? Yes. But if there's a really bad outcome, could it be up over 50%? Also yes. I came to this conclusion because I knew how investments like these might react on both sides depending on how the news came out, because I've seen it happen many times before and I've documented it. I also said that I'd likely view any short-term weakness as a buying opportunity. And we know that that also worked out as the market recovered quickly. This is where I hope I can help get you to. Obviously, if you can perfectly predict the future, that's great. But the reality is that we'll all be right sometimes and wrong other times. True investment skill is in being able to increase your odds of a good outcome even if you're wrong. Next, we helped people navigate through the incredibly uncertain times in April 2025. First, we pretty much called the taco trade, Trump always chickens out, before that term became popular. Unfortunately, what was really happening wasn't quite as funny or catchy as taco, but we did pretty much nail exactly what would happen in this video from April 3rd, 2025.
I'll break down 5 of Trump's signature strategies from the book, how they apply to tariffs in 2025, and what this tells us about where things are likely headed. Number 1, use tariffs as leverage. This is from the Art of the Deal lesson, Use Leverage. In Trump's world, tariffs are not just economic tools, they're bargaining chips. To sum it up, tariffs are the stick, the deal is the carrot. For all the bravado, Trump knows his supporters want real results. Tariffs aren't the end goal. They have to create visible outcomes. So what's the end game, and what does all of this point to? Let's break it down. Tariffs will remain or escalate, especially on China. This keeps Trump in control of the economic narrative. Once the pressure pays off, Trump will announce a breakthrough deal. Even if it's small, he'll frame it as a massive win. He'll selectively roll back tariffs to reward cooperating partners and punish those who don't. Bottom line, in the very short term, there could be more volatility around retaliation and escalation, but ultimately, it's more likely than not, these were designed to extract concessions from other countries. So, in my opinion, a lot of the negative is likely behind us, and a lot of the positive is likely in front of us. Keep calm and carry on.
So Trump wasn't actually chickening out. Starting big on his tariffs was always just a strategy to extract concessions out of other countries. 2 days later, on April 5th, we expanded on this by diving into my process for profiting on stock market turmoil and showing exactly how it applied to that specific situation. The biggest trade war in over a century has the stock market deep in the red. And while a lot of the media wants to scare you, I want to show you how to profit from this environment. This is a huge opportunity that investors should be excited about, not scared of. And in this video, I'm going to uncover my secret process for making a lot of money when there's stock market turmoil. And at the end, I'll show you how I'm implementing that process today. The market could go down way more than it has so far. But ultimately, if you understand Trump's negotiating strategy and what his priorities are, the potential for a recovery in the coming months gets a lot clearer. Let's start with his priorities. He wants to pass a big tax cut bill, probably this summer. He wants to end the war in Ukraine. He wants the Republicans to win midterm elections in 2026. And let's think about his tactics. Some of the key tactics he lays out in his book, The Art of the Deal, are to use leverage, start big, and ultimately deliver the goods. How would the market react if he did start focusing a lot more on passing a tax bill and a lot less on tariffs in the next couple months? Probably pretty well. The market doesn't like tariffs, but it loves lower taxes. What matters more than the details is that the media narrative will be shifting from negative to positive in the next couple months. While the market is focused on tariffs now, and there might be more to come, and then companies will start cutting earnings and consumers will start cutting spending, and there could be a lot more negative headlines in the short term. Ultimately, I see a lot of signs of a likely recovery not so far ahead. A few months from now, the headlines are much more likely to contain things like trade deals instead of a trade war, tariffs falling instead of tariffs rising, and tax cuts instead of price hikes. Those are likely to be good for the market. And while I do think there will be more downside from here, I've already started buying because ultimately, I know I can't reliably predict the bottom. I think the market is attractive from here on a multi-year basis, and I'm confident that my process can generate strong returns in this environment because it has many, many times before with an incredibly high rate of success. So you might be wondering, what am I buying? Well, I actually made 4 purchases on Wednesday, and I'm keeping 3 of them exclusive to the Fundamentals of Finance Academy members, but I'll share one with you. TNA is a 3x US small cap ETF. Small caps are also the most vulnerable in a recession, which is why you can see they've been selling off a lot over the last couple months. But small caps actually did really well in Trump's first term, and I don't think he wants to cause a 4-year recession and go down as the worst president in history. If the economy recovers, small caps are likely to recover. When its small caps recover, TNA will likely recover a lot. And how did that work out? Well, You could see it was at 2132 as of market close when we posted the video, and it finished the year more than twice that high less than 8 months later. Not bad. And how about the other three? Well, those were SVIX, an inverse VIX ETF, YINN, a 3x China ETF, and EURL, a 3x Europe ETF. And how did those do? All of them were up massively over the rest of the year. But let's look for something that didn't go as well. These are my top 5 ETFs for 2025. And most of them did average to good, but one was a disaster, and there was definitely a lesson to be learned from it. Let's start with the first ETF, which was really an explanation of what I was not going to cover, why I won't be covering in a US large cap ETFs today. I just don't find US large caps very attractive right now. Why? Because I think they're too expensive and priced for perfection. Of course, they went down almost 20% over the next couple months, and even though they finished with a strong year in historical terms, they didn't do nearly as well as some other asset classes like international and emerging markets. That was an area I made the case for. November was the largest monthly excess return for the S&P 500 over the main international index, the MSTY Crash, ever. Historically, when you've seen a big gap like that, it's been followed by a reversal over the next year. That was unpopular at the time, to say the least. But here are the two main international index ETFs in purple and orange since the start of 2025, compared to the largest S&P 500 ETF in blue. International equities dominated U.S. equities in 2025. That was more of a long-term conviction rather than an ETF I saw something special in for 2025 specifically, but I'd say it had an okay 2025. CGXU in yellow trailed the two main broad passive ETFs, but it still beat the pants off of U.S. equities in blue, and it also beat the largest passive ETF in its category, EFG, pretty handily. The reason it trailed the broad benchmarks in 2025 was because of that FG you see there at the bottom, which stands for Foreign Large Growth. Growth-oriented funds outside the US generally struggled in 2025 because it was more value-oriented companies like banks and mining companies that led the way. Core benchmarks have a lot more of those. CGXU is diversified, but it does lean toward growth, so it trailed the more core-oriented benchmarks and generally beat most of its more growth-oriented peers. 74% of them, to be exact, which is what the 26 means. It was in the 26th percentile of its peer group, meaning it beat 74% of its peers. On average, it beat them by about 6%, which you can see from those top two highlighted numbers. That's pretty good. So the call for international was good, and CGXU did well relative to its peers, but a more value-oriented ETF would have been an even better call for 2025. What's a lesson to take away from this? Well, even the best equity funds only beat their benchmarks maybe 60 or 70% of the time in a given year. What really matters is long-term consistency, and that's precisely why I chose CGXU, so it would still be my pick for 2026. Here's the one that didn't go well, and I would not pick for 2026 or any other year ever again. I picked SVOL within the high-income category. Granted, I don't like much of anything in the high-income category, but when I first analyzed this fund in 2024, I thought it was a much better way to approach high-income investing. Can you capture that consistent upside, but limit the risk of those big downside spikes? SVOL tries to do that with 4 ways to limit risk. Unfortunately, they completely changed their process and took out a lot of the things I liked about it, which prompted this video a few months later. The headline pretty much says it all. Here's the lesson learned that we went through in that video. I'd like to say the moral of the story is always check to make sure the investment process of all your investments stays consistent, and I guess in a way it is, but honestly, you really shouldn't have to do that. This kind of thing very rarely happens in the industry, and it honestly would give me pause when considering any investment from Simplify in the future. SPOL is up about 4% total return since January 1st, 2025, so lower return and much higher volatility than the S&P. And if you'd been taking out 15 or so % income payments, like most investors, you would have recovered even less. Our next two ETFs for 2025 don't have major lessons, but I'll cover them each quickly for completeness. Our top bond fund for 2025 was PULS, the PGIM Ultra Short Bond ETF. I call this one the CD killer. I think ultra short bond ETFs are always more attractive than CDs and high yield savings accounts, and right now, I think they're also more attractive than intermediate and long-term bond ETFs. And within this category, I like PULS more than cheaper passive options. So I'd say we were right on 2 out of 3 here. We called it a CD killer, and it definitely was. The average one-year CD rate when we made this video was under 2%, and PULS returned about 5% in 2025. Much better. It also beat 66% of other short-term bond ETFs, which you can see by the fact that it was in the 34th percentile of its Morningstar category. But it did not beat most longer-term core bond ETFs since interest rates fell and gave them a little extra return boost. I also got small caps half right. I said that small caps are another area that I find attractive right now. Remember that chart I showed earlier with large caps in red and mega caps in pink? Well, that's small caps there in green, and on a relative basis, they're about as cheap compared to large caps as they were during the tech bubble. Small caps, which are represented by the yellow line, the iShares Core Small Cap ETF, didn't do as well as large caps, represented by the purple line, SPY. But DFAS, the ETF I covered, did at least do better than passive. I still find small caps to be more attractive than large caps, and I still think DFAS is a fine option within the ETF space, though I'd rather give up a little tax efficiency to invest globally with a mutual fund. Our last call for 2025 was a relatively unique opportunity, which I guess I'll call a wash as to whether it was successful or not. Allow me to explain. One really unique opportunity that I'm seeing right now, YCL, a 2x Japanese yen ETF. Here's why I think it's attractive, which caused the yen to weaken by about 50% against the dollar. Over the next few years, I think that's likely to reverse. One of the best parts about this investment, in my opinion, is that it could do well in an equity market downturn when most other investments are likely to be falling. YCL definitely did do well when the market was falling, but overall it was a bad year. Then again, I said I expected this trend to reverse over the next couple years, so TBD if this one will turn out to be successful in the long run. I still like the role it plays in my portfolio, and I also still like its potential to recover if the US cuts interest rates over the next couple of years. This one definitely has a lesson I'll take with me into the future. In hindsight, what I should have done here is sell when the market was down and YCL was up. This is a challenge that comes into play when there are two different reasons to own something, and I definitely could have handled it better. Here's my lesson to get better from this. When there are two reasons to own something, evaluate them separately and consider whether one or the other is dominating the returns over the short term. If the only reason I'd owned YCL was to do well in a downturn, I probably would have sold some or all of it in April. After all, I clearly thought there was going to be a recovery. However, I was still thinking about the long-term thesis I had and still have for YCL, which is US and Japanese interest rates converging, which should strengthen the yen. That hadn't really happened yet, and I still felt like it would. The problem was that the short-term market fears had already driven up the yen a lot. Not to where I thought it would go in the long run, but they'd clearly been driving it in the short term, and I had a clear view that the short-term fears would subside, leading to a stock market recovery. The insight I should have taken from that was that YCL's long-term case may still be intact, but in the short term, it was highly vulnerable to a reversal because the short-term phenomenon that had been driving it up was likely to reverse. If I'd separated out my two theses for owning YCL and evaluated them independently, I would have come to that conclusion and sold some or all of my YCL and then waited for a more attractive point to re-enter. I did actually add more on weakness later in the year. I just failed to sell on strength when I should have. That's a mistake I'll be less likely to make the next time a situation like that presents itself. And hopefully now you will also be less likely to make that mistake. Another early year market call we made was UBR, a 2x Brazil ETF. On January 11th, I said that I think there's a real chance it could double in 2025. And it has almost exactly doubled since then in just under a year. By far our most disliked video of the year came in March when I called MSTY, the YieldMax MSTR Option Income Strategy ETF, quite possibly the worst investment I'd ever seen. Of course, it was universally loved at that point, and it had just gone up 168% in just over a year since its inception. It was showing a yield of around 100%, and it was receiving universally positive coverage on YouTube. Unfortunately, it's gotten crushed since we put that video out, despite the fact that Bitcoin is up and its underlying investment, MSTR, is basically a leveraged Bitcoin position. Here are some of the lessons I hope MSTY and other high-income investors learned from our video that we made after MSTY had started to collapse, when we showed some of the issues we'd previously warned about in action. That's where the main issues come in for anyone hoping to actually take out the income. A lot of what they call income is really just them giving investors their money back. ROC, which you can see there on the upper right, means return of capital. When an investment pays out more than it earns, it's treated as return of capital, which means you don't pay taxes on it because you didn't actually make any money. They just gave you your money back, essentially. So, since the fund is paying out more income than it's earning in returns, its NAV will inevitably fall over time. And the income payments are just a percentage of the NAV. So, if the NAV is falling and the income payments are a percentage of the NAV, that means the income will fall over time. That is why the income has fallen over 80% in the past year. The main lesson from the series of warnings we put out on MSTY and other similar ETFs is beware of ultra high yielding covered call ETFs. They're essentially the dictionary definition of too good to be true. We also had a somewhat controversial take on SCHD, which wasn't even that there was anything wrong with it, simply that it just wasn't the greatest thing since sliced bread.
Unpopular opinion. Honestly, SCHD is really not that great. I totally get the appeal of SCHD, and there's nothing inherently wrong with it. But I think there are some objectively better alternatives out there. But in a lot of ways, VIG, the Vanguard Dividend Appreciation ETF, DGRO, the iShares Core Dividend Growth ETF, LGLV, the SPDR, SPDR, SSGA US Large Cap Low Volatility ETF, and CGDV, the Capital Group Dividend Value ETF, are all better alternatives.
That meant in the long run, not specifically for the rest of 2025, but so far, 3 out of 4 of them are ahead of SCHD since we published that video. Why didn't LGLV keep up? Well, here's what we said about it in the video.
LGLV is the only one that specifically targets lower volatility. It's not active, it's passive. And there's no guarantee that its rules-based approach will be the best at limiting downside risk in any particular downturn. But if I had to guess which one would be most likely to do that, it would be the one that focuses on it, which is LGLV.
So, since the market has gone pretty much straight up since June, I wouldn't exactly expect LGLV to do well in that environment. But the appeal of LGLV is that over a longer period of time, when there are more ups and downs, LGLV has the potential to lose less in the downturns and make up for some or all of the ground that it might lose on the upside. We also introduced a bonus fund that we preferred over all of them, CGDG.
There's one other one I would pick over all of these, and that's CGDG, the Capital Group Dividend Growers ETF. This one is newer, and it's not a direct comparison since it's global, but that's one of the main things I like about it.
CGDG, which is the red line, also beat SCHD, but it didn't do as well as some of the other US dividend ETFs we highlighted in the video. Still, 4 out of 5 ain't bad. I actually think SCHD is a lot more attractive now since its strategy has fallen so far out of favor. That's more relative to the S&P than these other ETFs, and it's more of a next couple years call than a next 10 years call, but it will be an interesting one to revisit at the end of 2026. The moral of the story here is that popularity on social media is a pretty terrible predictor of what will do well in the future, or for that matter, which channels to follow. Here's the simple formula to grow when you have a finance channel on YouTube. Clickbait, fear-mongering, and tell people what they want to hear. That's the combination of things that helps a channel grow. But Kyle and I refuse to stoop down to that level. If you'd find value in a channel that gives you professional level insights and is specifically designed to teach you how to significantly improve your life by becoming a better investor, now would be a great time to hit that subscribe button. I'm not saying Kyle and I are oracles that will always be right, but you can see that we've been right a lot more than we've been wrong. Obviously, we can't go through every video from 2025 because there were 55 of them, but I tried to cover a subset of the ones with the most valuable lessons I could pull out. Looking forward to 2026, I still think AI is in a bubble that's going to burst at some point in the near future. Maybe 2026, maybe a little later, but this remains one of my highest convictions. I also think that biotech companies are a long-term winner from AI, which is more of a 10-year call than a 2026 call, but nonetheless, I remain invested and I think more people should be talking about this. I also think David Giraud is one of the most legendary investors you've never heard of, and his ETF is one of the best things that you can buy for the long term. I still think gold has changed in ways that create new risks and opportunities in 2026, and I think that our most recent video about why your income matters less than you think should be required viewing for every high school and college student and could literally be the most valuable 15 minutes of content we have ever produced. Our entire goal with this channel is to help you significantly improve your life by becoming a better investor. So if you've made it this far, thank you so much for watching. Please leave us a comment with what you'd like us to cover in the future and hit that subscribe button so you won't miss it. We'll look forward to seeing you in the next one.